Hey, good morning, everyone, or good afternoon, wherever part of the country you're from. My name is Monty Tarnall. I am one of the marketing managers here at Back9. If you have never used Back9, we are really a technology IMO. So I would recommend taking a look at our products after the seminar today, after the webinar. We have some of the most amazing technology to make the life insurance process so much easier for agents. And we can give everyone a quick 5-10 minute demo. You can set up a meeting. I'll have my contact information at the end of the meeting. So you can ask me any questions regarding the seminar, because we're going to do our Q&A. We're not going to have really time for today. So after the meeting, you'll have my information. You can send me an email or call me, and we can answer questions on Kaizen, which you're going to learn today, and also about Back9's technology, which is really amazing. We've probably spent over $2 million building it out. Make sure you contact me after. Today's webinar is going to be on Kaizen, and it's from a company called NIW. And I have personally known NIW for at least a decade now. And that's really important because when you're talking about these types of products where you have lenders involved, there's a lot of back office work and a lot of administrative work every year that comes with these products. It's not just sell a life insurance policy and then walk away from it. You have to administer these every single year. You have lenders involved. You have loans to pay back. You also have, which is the best part of the product, is we have money coming out as income for your clients. So we have Travis Fertini here from NIW, and he is going to give us a really nice webinar today. And again, if you have any questions after the webinar is over, I'm more than happy to answer questions, even set you up a quick call with Travis, and maybe even do a personal webinar for you and maybe a client. So I'm going to turn it over to Travis now, and enjoy the webinar.
Thanks, Monty, and thanks for everyone for being on the call today. Monty called about 4 or 5 months ago, and we started this relationship. He was at a conference about premium financing with another company, and he thought, gosh, I remember NIW and Kaizen, and really this opportunity has really changed the shape or idea of what premium financing has mainly been understood as, which is a high net worth estate planning opportunity. And let's face it, that's still a big part of what premium financing has to offer for that very, very high net worth client that has a really big estate planning problem. Premium financing is a great solution for them. But Kaizen was created for a very different client, a very different demographic. So we're going to talk about that today. And Monty, you're going to have to help me understand. Maybe it's this button here.
Hang on just a second.
Here we go. A little bit of history about NIW and why Kaizen was created. NIW was formed in 2000. So as Monty says, he's known us for 10. We've been around for almost 20 years now. And our business was traditional premium financing, helping the high net worth client deal with their estate tax planning. And we've facilitated over $5 billion of loans with various banks and various insurance companies over the past couple decades. But traditional premium financing is again really reserved for the client that has a net worth of 20, 30, 40 million dollars that really does have an estate tax planning issue that could be addressed by using premium financing. Well, about 7 or 8 years, well, actually a little longer than 7 years, because that's how long Kaizen's been out, but about maybe 8 or 9 years ago, Grace, the founder of the company, thought, well, how cool would it be if I could create a financing opportunity for my high income earning employees to create better and more benefits than traditional benefit plans were offering, especially retirement benefit plans. The 401ks, the group life insurance, all those are great, but in many cases they're insufficient to retain key talent within an organization, and the traditional plans just aren't sufficient enough for them to save enough in them to actually maintain the lifestyle and retirement that they're currently that they currently have today. So her goal was, well, what if we could borrow money at the same rates we're borrowing money for my high net worth clients? What if I could do that for my high income earning clients? So she took this out to the market and found a way to create that same kind of leverage her very wealthy clients were enjoying for her employee base. So I want you to think about that for a minute. You know, when someone goes to the market with an idea for themselves and their employees, you can imagine that the plan would have to be very low cost. It would have to provide really good benefits. You would want to remove most of the risks associated with leverage. So think about it from the owner's perspective when going out to market. This was for her and her employees. Well, before you knew it, once it was created and established, everyone that was involved in creating the Kaizen program wanted in. And that led to taking this to retail. Just to let you guys all know on the call today, Kaizen was never initially meant to go to retail, the public. But there was so much tremendous positive response, Grace decided to open it up to the independent advisor and insurance agent. And now we're 7 years in, and we've never been more successful. And we've got a tremendous amount of happy customers along the way. So that's a little history of NIW. I want you guys to think about this statement as we're going through this. And it's a statement that even you might even consider talking to your clients about. This question here, did you pay cash for your house? Well, most clients are going to say, no, I didn't pay cash for my house. I mortgaged my house. And we know that to be true. But think about this statement. Saving for retirement should be no different, as it will cost 6 to 9 times more. Now, if you think about the house that your clients are living in today, let's just say if you're here in wonderful California, that's a $8 to $1 million house. We know that individuals' nest eggs need to be $6 to $9 million to retire for 23, 24 years in retirement. If we finance our homes, why not finance our retirement to give us the income that we desire or need? And it might be the only way to achieve the goals that we are trying to achieve, because without it, we have to take more risk, we have to save more money, we have to reduce our lifestyle, or we have to work longer. And no one wants to do any of those four. So financing might be the solution to overcome that retirement income gap that we're looking for. But imagine being able to get that leverage, just like you or your clients are getting with their homes, but you can do it with no loan underwriting, no interest payments, no financial underwriting, and be able to provide your client with 60 to 100% more income than other traditional financial income plans or traditional IUL plans. That's what Kaizen is. So let's first start off with who's the customer. Who are you looking for? What's the qualifications and identification marks of a Kaizen client? Well, you're looking for people between 18 and 65. That's the age range at which the carriers and the lenders are comfortable with. I will tell you, we have very few 18-year-olds and we have very few 65-year-olds. What you're going to really look for is individuals between pretty much 35 and 55. They're in the prime of their employment. They're higher income earners. They're earning at least $200,000 or more a year. They're in good or standard health from an insurance standpoint, and they have the ability to make 5 annual premium payments. That's a big key part of this Kaizen plan, guys. Anyone selling 10, 15, 20 pay overfunded IULs today, I will tell you, when you stack that plan up against a Kaizen plan and be able to show your clients that they can achieve the same or more income off of 5 annual contributions, that's a really big selling point. And then, of course, the need for life insurance. This is a overfunded life insurance contract. You're going to need at least a minimum of $1.5 million to qualify into the plan. So, which again, most income earners at $200,000 will have no problem getting that qualification, but there does need to be a justification for the life insurance. Now, there's a unique opportunity in the group space. You may not be in that space right now, or maybe you are. We have special underwriting considerations with Kaizen with one of our carriers, National Life Group, and they will consider GI and SI opportunities for groups of 15 or more, depending on the participation of the group. So if you in fact have groups, maybe hospitals, small business owners, that want to qualify under a GI or an SI underwriting opportunity, up to, in many cases, $1.5 million of insurance, let Monty and the group here know, and we can discuss those opportunities. You will not find this group GI or SI offering on National Life Group's website. This is a special underwriting consideration for Kaizen business only. So if you have those kinds of cases, let Monty and I know, and we can definitely point you in the right direction. Who should I be targeting, or who should you be targeting for Kaizen? Really anyone that you're probably targeting overfunded life insurance to now, but they're going to be typically your highly skilled starting late in life in regards to saving, maxing out their 401k and high tax brackets. You know, you're looking for individuals that are looking for an alternative asset class than what they're currently doing now, or they need something more because they already are maxing out their other alternatives. So what we have is a lot of self-employed business owners, doctors, dentists, financial services, all these. This is the group that has been the most appeal to the program, because it does provide them an alternative to what they're currently doing. So this is the sector I would look in. But you guys, we put business owners in there because we don't care if they're widget makers. If they're making six figures, they have the same problem as everybody else. So Kaizen is a great solution for all these segments. Now, I want you to think about this from your perspective as an insurance agent or a financial advisor. Every single person is offering the client choices. That's product choices. I've got a mutual fund at a certain rate of return. I've got a portfolio that gets you this. There's all kinds of choices, right? Kaizen, though, is the only plan where you're where you're the only advisor really providing the extra money to pay for it. I want you to think about that. Every time you go to a client appointment, you're having to convince your client to change their lifestyle, because you're going to ask them to set aside so much money for this plan that you're putting in front of them, whether it's IUL or whatever it is. It doesn't really matter. And in many cases, you and I know that, you know, what they can ultimately afford typically doesn't get them where you know they need to be. So you're kind of stuck, right? Let's just get them into it. Maybe they can save more later. But with this plan, it's interesting. You're the only one saying, I can bring 75% more of the premiums to the table to actually help you achieve that goal without dramatically changing their lifestyle. That's a pretty big positive selling position to be in as an insurance agent. So we really need to get down to how our clients feel. Do you know how they feel about their plan? Do you know what they're worried about in regards to their retirement plan? Basically what we're hearing is that Americans are really worried about their inability to retire, or forced into it, reducing their lifestyle, working longer. This is their biggest fear. So are we addressing that in the conversations we're having? We know, and this is at least something that statistically we all know, that Americans are some of the worst savers in the developed world. We've got a really big retirement income crisis going on, and this is a hot topic. So the reality is, it's not a higher rate of return. It's not saving more necessarily. It's not working longer, because no one wants to hear those. It's that they just need more money in the plan. That's what's really going to change the outcome. So let's talk about what the top earners are making. Well, the top 1%, this might be shocking to a lot on the call. Top 1% of the Americans are making about $465,000. Now, I think a lot of people think more people are making more than that, and that's just actually not the case. Now, the top 10% of Americans are making $160,000. Now, what's interesting is that this is what we are being told these individuals need to have saved in retirement. The top 1% need about 3.8 million in their retirement accounts, and the top 10 need to have about 1.6 million in those accounts to successfully retire. Now, what's interesting is look what's actually in their retirement accounts. 1 million for the top 1% and 274 for the top 10. Guys, this is a problem. This is a problem that many face. So this is a needed solution for a massive problem that a lot of our clients are facing here in the United States. And in reality, they're only saved 1/4 of what they need. So how are you going to, again, accomplish, if you're sitting down doing a financial plan for somebody, how are you going to accomplish that when they're deficient by 75%? Might be that the Kaizen solution will get them there. So think about this number right here. If a 45-year-old earns $250,000 a year, how much do you think their Social Security is really going to replace their annual income? It's minor. So what's going to make up for the difference? Well, we had a report ran that said if you started saving started saving a percentage of your income and earning about a 5% rate of return, if you were making $250,000 a year, at 25 you would have to save 13% of your income. Well, I remember 25, and I know I wasn't saving 13%. And as you can see, 30, 35, 40, at 40 years old, if you just started saving now, you'd have to start saving 34%. Guys, nobody can do that because they can't afford that. To start putting $85,000 now today away would, again, it would break the bank, and they can't do that. So again, what's the solution to fix this problem? Second, medical expenses due to illness. Very few realize the actual impact of this cost. I know with Back 9, you guys probably are using asset-based long-term care and LTC riders. There's a lot of benefits to having these accelerated benefits. Now, will you use them? Are they exactly what it's not long-term care, but it's just options that you have to access living benefits in case you need it. Now, what's interesting is everyone thinks that critical illness and chronic illness are an older person's problem. Now, I can tell you from my experience, I'm 43 this year. I had a massive heart attack when I was 40, and it almost crippled the family. So I will tell you, I have a lot of life insurance. I have no critical illness. Now, it's a little embarrassing being in the business, not having critical illness, but I happen to live through it. But if I would have had a policy with critical illness, that would have changed a lot for my family and I. So this is still a really good conversation piece to have, depending on the carrier you're using, in regards to taking care of or addressing the costs associated with these medical emergencies, going and accumulating wealth as well as getting into retirement. Now, probably another big talking point, and this is just an IUL talking point. We're just making it better with Kaizen. Is that what will the tax rates be when I retire? There's a lot of arguments about that, but all the stats are telling us that taxes have to go up. And I don't care if you're a Democrat or a Republican. I don't think it's a partisan issue. I think that our debt is going to drive our taxes a lot higher than what we're seeing today. Social Security is projected to run out in 2020 based on the CBO. This was a 2013 quote. Medicare funding's running out. I mean, we can go on forever, but in reality, is our plan prepared to be tax diversified when we're in retirement? That's a big question we should be asking our clients. Are they prepared for the fluctuating tax rates that might impact us in the 23 to 25 years we're in retirement? And most clients will agree. I mean, if you look at this scale of tax brackets that have been all the way back to 1913, most clients don't realize that we had a 94% federal tax rate back in 1944. We have been in some of the lowest federal tax brackets the country's ever seen in the past 3 decades, but with the most debt ever. So we really need to be able to show our clients that there is a significant impact on their income based off of the various tax brackets they might be in for 2 to 3 decades. So the real question is who's going to fund that gap? It's probably going to lean more on us as individuals, because the government really can't afford it. Pensions have gone away. Company benefits have slowly decreased. Again, those company pensions aren't there. We're now pretty much self-reliant on achieving that goal. And when it comes to the alternative, what do we have? Most of us, our clients, have 401ks. And we don't want to discourage them from putting money into their 401k, but this is what they're currently up against. So the question is how does Kaizen kind of compare to the 401k? Well, 401ks are 100% in the market. You get 100% of the upside, 100% of the downside. With Kaizen, with your IUL solution, we know that we're capturing about 80% of the upside of the market with no downside risk. That's a huge advantage. Yes, 401ks get tax deferred growth, but they're taxed on distribution. Life insurance, as we know, yes, you pay taxes on your contributions now, but we get tax deferred growth on the way, and then we get to take that money out on a tax favored basis. We've got contribution limits on 401ks. This is why the high income earners need an alternative. What did I just say that clients need to be putting away just to maintain a lifestyle in the future that they're getting today? $85,000. Look, the 401k you can't put enough in it ultimately to get what they are going to need in retirement. Life insurance, you don't have the contribution limits. It's just going to be based on what they can qualify for. How about contributions and access and fees in regards to how long you pay into it? 401ks basically till you're up till retirement, and you're forced to take the money out at 70 and a half. You wouldn't believe how many clients still can't believe that they're forced to do this at 70 and a half. The beauty of life insurance is that you don't have those same early withdrawal fees, nor do you penalties, nor do you have forced distributions. With Kaizen, you're done paying this in 5 years, and you have access to distributions as early as you're 15 or 16. So a lot more accessibility to the plan than the traditional plans out there. And let's face it, cost structures inside of 401ks can be, in most cases, 1% or higher. A well-designed IUL, even in this environment, we can get those costs at or around of that 1% mark, just like your 401k. And I would argue in many cases 401ks may be more expensive than even 1%. Your 401k does not provide the overall benefits that life insurance does. The Kaizen plan gives you the death benefit and access to living benefits if needed. And then of course servicing. I mean, I was in a 401k for years. I don't think I had a single person call me about rebalancing or servicing my 401k. NIW services these contracts on an annual basis, optimizes the death benefit, does stress tests on it on an annual basis to ensure the validity and the success of the plan. You get that when you buy a Kaizen plan for 15 years until that lender gets paid back. So there's a lot of advantages to the Kaizen plan. And then on top of it, 60% more income and 50% more death benefit than if you were to just fund your own IUL plan. So what does this Kaizen leverage mean? Well, more money going into the plan, more money working for you, which means more money in death benefit and in retirement. And for a high income earner, they're not going to be constrained by the contribution limits. And then this also means that you get access for every $1 that you put into the plan, the lender is matching an additional $3. And then you get access to this leverage, this bank leverage, for up to 15 years at very, very competitive lending rates. Right now, as long as Kaizen's been in play, we've had our lending rates at 1-year LIBOR plus 175. I think right now, all in with that 175, we're around 3.8%, 3.7%. We are at a historical low LIBOR rate right now, but our spreads have stayed this way for as long as I've seen the plan in place. And that's primarily because of how we're lending, what the banks are lending to, and all the servicing that NIW does. We can give you that really competitive 1.75 spread on the loan. Now, how does this actually work? What does it look like? Well, and how much leverage are we really getting? Well, this happens to be a 45-year-old male putting in $34,850 a year. The bank's matching $26,679 in the first 5 years. And then what you are done as a client in year 5, your client is done paying premiums, and the lender picks up the full annual premiums years 6 through 10. So this is, again, that 3-to-1 leverage, $434,000 of bank leverage, with a total contribution of $174,000 from your client, and they are done. Now, what does this look like? What's this look like to age 65 and beyond? Again, in the first 5 years, the client puts in their premiums. Those premiums are pretty much covering all of the costs, the expenses, the fees that are normally associated with life insurance. And then the rest of that bank financing grows inside this cash accumulation IUL policy. After the 10th policy year, we take the death benefit from option B to option A, and we let the policy grow for an additional 5 years. Now, I will argue that most IUL plans need 10 to 15 years. You know, to stomach the ups and downs of what the market might be in, I think for a really good accumulation policy like this, you need 15 years. So we hold for 15 years. We have enough cash value in the policy to exit the loan. So in this particular case, we take a participating loan against the contract, pay the lender back, we exit the trust, and then we let the policy, or you let it grow to age 65. Now, you can start taking income as early as 16. All of our illustrations show a accumulation period to age 65, at which time you can start taking, in this case, $57,000 a year out of the policy from age 65 to 90. So this is what you're gonna ultimately see in a ledger, and we're gonna go over the ledger in a few minutes here, but that's the structure of the Kaizen plan. Now, we're going to look a little under the hood, and I want to show you the illustration, because this is when you get access to this and you talk to Monty to get access to the website. First of all, go on the website, download a quote, and read it verbatim. There's 8 pages. It has all the FAQs. It's a really actually good sales presentation tool. Learn it. Most of your questions will be addressed inside this illustration. So I would suggest that you download the illustration, but let's go ahead and look at this. This is the first page of the ledger. It talks about kind of what's going on in the insufficiencies that we see in traditional retirement planning. We clearly want to bring out the protection benefits of Kaizen. We have no qualms about making sure that the client is very well aware that this is a life insurance contract with all of the benefits associated with it. So it talks about protecting not only you, but your family. And then it goes into the cash accumulation features of the policy, explaining how the growth works, the benefits of the zero floor, the tax deferred growth, the tax-free income. A lot of this is what you would find even on an insurance ledger, but we've taken a 35-page insurance ledger, shrunk it down into 8 pages. So it's a little bit more simpler for your client to understand. Then here it talks about the unique use of leverage, and it shows the amount of premiums that your client's going to be participating in those first 5 years. And then on the right-hand side, it discusses the total amount coming from the lender. And then this page is pretty much comparing the Kaizen plan against either a self-funded or a after-tax investment. An after-tax investment would be taking the $34,850 maybe as a bonus, paying the taxes, and then investing it into something with a 6.03% rate of return. FYI, guys, that rate of return is strictly the rate of return based off of the carrier illustration. We're just using that as our assumptions across the board. If you were to do that, take that same $34,850, invest it, and take distributions from 65 to 90, you get about $25,000 of annual income out, a total of $653. If you were to put the same amount of money into a 5-pay max funded IUL, that would generate about $28,000 of income, tax-free, of course, total $728, but you've got a death benefit on the plan. But then look at Kaizen, the same exact $34,850, we increase from $28,000 to $57,000 of potential income, 1.4 million of total distributions, and over 1.2 million of total protection at age 90. So that there's a big difference between that. Again, that Kaizen leverage changes the overall benefits by 60 to 100%. Now, what about the stress test? We talk about the stress test a lot at NIW. It's a really important part of our story. What we have noticed in the industry today is you don't see a lot of companies stressing the contract to make sure that it can survive through what we deem, or what we at least perceive, are 2 of the most stressed economic environments in the United States to date, which is, from a financing perspective, a high interest rate environment of the 1980s. If anyone's on the call today remembers what that was like, we're going to show you a snapshot of it. And then, of course, the Great Depression. There's never been a time where we've had 9 zeros in a 15-year period since the Great Depression. So those are two factors that we bring into the Kaizen, to every one of the Kaizen plans. Let's talk about the Great Depression. So that Great Depression estimator is assuming what you see on the screen right here. We're assuming a borrowing rate of about 4%. Now, during that period of time, borrowing rates were actually a little lower than that. They were in the low threes, but we, from a stressed environment, decided to take it up to 4. And the actuaries basically told us, look, we didn't have an IUL back in the 30s, but we, based off of what we believed options would have been, we would have been able to probably have an about 11.25 cap during that period of time. So what we do is we take the illustration, we overlay it on this scenario, assuming 5 zeros from day one. You got a couple 11.25s, another 0, 11.25, and 3 more zeros in that 15-year period. Now the stress test basically says this: we can pay back the lender plus interest, wait till age 65. We can pay the lender plus interest and get the bank paid back under a Great Depression scenario, and still be able to get $34,000 of potential income at 65. Now, what I want you to notice is, what was my self-funded income at? You can see it's $28,000. So even in a stressed condition like the Great Depression, we were still able to pull out more potential income at age 65 in the Kaizen plan than if I was in a self-funded plan. Now, what about the stress test of the 1980s? A lot of people think that this is going to blow up a finance case, but in reality, interest rates historically correlate with the options budgets and the abilities for an insurance company to offer higher rates of return, higher caps. If anyone was in the business in the 80s, fixed UL contracts were paying 12, 13% in the early 80s. That's because their long-term bond rates were in the double-digit range. They were bringing in premiums, investing them, and being able to give clients 12 and 13% rates of return on fixed UL. The insurance company actuaries told us this: if that kind of spike in interest rates ever happened again, and we were taking in new dollars at those rates, within about 2 years, 24 months, we would be able to elevate our caps to around 15 to 17%. We've had a couple actuaries say, you hold long enough, we could have had uncapped strategies back in the mid to late 80s. Now, I remember in the early 90s, cap rates being 17%. I think back when the old mutual F&G days. So we know that cap rates can be that high. They were basically taking advantage of a bond portfolio that was slowly deteriorating, but caps will go back up when interest rates go back up, guys. So what we're trying to achieve here ultimately is a spread. And that spread that we're trying to achieve over the cost of borrowed dollars is about 1.5%. Now, historically, we have seen about a 2% spread over borrowed dollars versus my earning rate on my IUL. To make Kaizen work, when I mean work, pay back the lender, we need about a 0.9% spread over cost of borrowed dollars. So if we get 1.5%, which is about what you're seeing in our illustrations today, you can see the tremendous benefit. But all we're looking for is this average spread of about 1.5 to 2%. So I don't care if I'm borrowing at 8 and I earn 9.5. I don't care if I borrow at 10 and I'm earning 12. I don't care if I'm borrowing at 3 and earning 5. What I'm more concerned about is my average spread over time that is over about a 1.5% rate of return. So understand that these spreads are going to fluctuate and adjust, and caps and borrowing rates correlate, and they always have historically. So, and as you can see here, the stress test environment of the 80s, we still were able to pull out $46,000 of potential income. So a lot of still better than the self-funded plan. So it's a really, really great story. Now let's look at the ledger really quick. The ledger details are pretty self-explanatory. So when you download these, you're going to see the age, male, smoker, non-smoker, the rate of return that we run from a carrier's perspective, the death benefit, The margin, that's the spread over LIBOR, which is 1.75%. And then in this particular case, we're using National Life Group. By the way, guys, we are product agnostic. If you like Minnesota Life, if you like Allianz, if you like National Life, that's up to you. Call your team here at Back 9. They'll also assist you with that. I'm just showing you a ledger right now. We use the 1-year point-to-point high cap with National Life Group. And just to let you know, from an additional stressed, I wouldn't even call it stressed, conservative approach, we're reducing the income potential, Monty, I don't know if you knew this, by 20%. So the illustration might show 65. We're taking that down 20%, again, to try to make this as most achievable as possible for the client, and the highest level of success rate for the client. So just understand those are some of the adjustments that we make to the ledgers to be a little bit more conservative. Now, again, what you're going to see from A to K all across the top, column A is the price of the loan. So that's LIBOR plus 175, and then the projection that we're getting from the lenders and the insurance companies moving forward. We do not create that 10-year projection. That actually comes from our lenders, and that adjusts on a regular basis. Because these are static illustrations, this is what you're going to get when you download it now. That will adjust when those change. Column B is the total annual premium going into the contract for 10 years. Column B is the contributions plus trust fees. There is a trust fee that is included in the annual premium for the first 5 years. It's $13.50. It's a part of the annual fee that puts the trust in place and administers it for 15 years. There are no additional trust fees after year 5, and it's embedded in that annual premium. Column C is the bank loan amount. Column D is the loan plus interest rolled up to year 15. And then column E is ultimately the loan, the amount that would have to be repaid back on an annual basis if something ever happened. Now, I want to get into column F, G, and H. These are some key points I want you to take from this presentation. Every one of these policies are designed with an early cash value rider. National Life, I think, call it a balance sheet benefit rider. Everyone has a different name for it, but it's basically a waiver of surrender penalties. And the reason that we put that rider on the contract is the policy is the sole collateral for Kaizen. So instead of your client having to set aside collateral, apply for the loan, and post that collateral while borrowing, the policy is the sole collateral to the lender. So the lender is not loaning your client the money. The lender is actually loaning the policy, loaning the money to the master trust, who holds the policy as collateral until that lender gets paid back. But that is a real safety net for your client, because then your client's not responsible for ever personally paying that lender back. The policy will always be the sole collateral for that repayment to the client. So if you look at column F and G, they're the same. That's the cash surrender value and cash accumulation value, and they're exactly the same because we waive those. Now, what you see in column H is kind of interesting, right? $23,737. That's the amount if your client surrendered the policy, the bank would get paid back their $28,384 that they are owed, and they would walk away with $23,237 in their pocket. Your client only put in $34,850. Now, I will tell you, go look at your own self-funded, overfunded IULs, the way you design them today, and there's only about 5 to 10% cash surrender value in your contract compared to what your client put in the contract first year. There's a lot of liquidity involved in this transaction. So from a risk profile, really, they're out about $10,000 of annual premium if they decided to walk away from the contract. Now, if the client passes away, in column J, that is the death benefit the beneficiaries would get after the $28,000 was paid back to the lender. And then I don't have to explain what's going on year after year after year. That it just happens year after year. Now, what happens in year 10 is something interesting that I'd like to show you. One second. What happens here in column I in year 10 is that we go, or in year 10 is we go from an option B to an option A. We do that administrative work for you. We contact the carrier and make that material change. And then we also do a reduction of death benefit right above the MEC limit. The purpose of this is to keep the cost of insurance as low as possible. And then in year 15, we exit, we pay the lender back. And then in year 65, we start taking distributions. I will make sure to address this face reduction. You don't want clients to get scared of that. That's a function of design. We're doing this on purpose. If they need more life insurance during those 15 years, sell them some term insurance that gets them through their insurance need. Let this be about the $57,000 of potential income in retirement. So just really focus there, or at least address that in your initial conversations with your clients. You might find that there's an additional life insurance sale that's needed with this Kaizen plan. Now, again, I want to reemphasize this. You get all of this leverage with no loan documents, no personal guarantees, no credit checks, and no financial underwriting. And it's not only a benefit to an employee or just an individual, but from an employer standpoint, if he wants to do this for some key employees, a lot of the plans out there require that employer to put their company finances on the line to finance benefits for their employees. Now, I will tell you, a lot of employers love their employees, but they don't love them that much. Not enough to put their company's credit on the line and finance life insurance. A lot of business owners really like this plan because if they have a budget to provide benefits and they want to reallocate it to an employee, they don't have to finance this plan. They just have to commit to the 5 premium payments. So it's a very attractive solution for a lot of business owners that don't want to go on a loan application for the traditional financing plans out there. So does this sound a little bit too good to be true? Well, it shouldn't. There's a lot going on and why it's not. A lot of it has to do with a few things. One's the design. We're specifically designing this as a max funded contract, max accumulation, lowest death benefit, lowest cost of insurance. We're funding this as tight as we can and as cost efficient as we can for everyone to win. So that's a big part of why this works. Our average cost of insurance, and this is a little low compared to the new CSO tables that we're now dealing with, but our average cost of insurance over a 15-year period or a weighted average is around 1%. So it's a very low cost product. Secondly, the banks have confidence in this plan because we've done all the stress tests. We're doing all of the annual servicing. We have a very high persistency level in the business that we have in place. We've been doing it for close to 20 years. So the banks have a lot of confidence in this plan, and that's why they lend to this plan. I also want you to think about it from a bank standpoint. You know, they have a lot of confidence in life insurance. You know, you might not think that, but there's a reason why we can get LIBOR plus 175, because they understand the asset class at which is life insurance. Look, if many people don't really think of borrowing as being very risky. I mean, you go to a bank, you ask for a loan, you agree to provide collateral, and you agree to pay it back with interest. That's all this really is, except that we're using cash value life insurance as collateral, and it's an asset class that the bank feels very comfortable lending to because one primary thing, they know that the policy won't lose a dime to negative market returns. Yes, there are going to be zeros, but on average, they understand the rate of return that IUL will achieve based on our designs. They feel comfortable lending to it. So if you really think about it from a bank's point of view, they appreciate the asset class for what it is and for what it does. The annual servicing. Now, this is just a glimpse into Grace's her own policy when she purchased this back on the very first tranche. She posts this every single year for customers to download. You're welcome to have a copy of her annual statement. As a matter of fact, Grace this year will be on her 3rd Kaizen policy as a policy owner. But you can see here, this is a sample analysis of what your client would get every single year for 15 years while while in the servicing of 15 years until that lender gets paid back. Now, since Grace has been in this policy, she's earned an average of about 8.72% rate of return with a borrowing cost of 3.5. You know, she's had a 5.2% spread. I mean, that's pretty impressive. What did I tell you the spread needed to be? What we're trying to achieve? 1.5%. She's way ahead of schedule. Now, is this going to happen every single year? Is this going to happen every single 5 to 10 years? Not necessarily at that spread, but she's had an incredible run, and most have over the past 7 or 8 years in IUL contracts. But this is what you can expect on an annual basis from NIW. This report comes to not only you, but the client as well. And then, of course, coupling all that with good carriers and carriers that allow us to design products that allow us to remove a lot of the typical fees associated with life insurance. So these are the core carriers. I talked to Back 9. You have access to all 3, National Life Group, Allianz, and Securian. So depending on your preference, give Monty a call and he can just kind of help you go through what those carriers are. So between the optimizing of the design, the stress testing, the annual services, you can give you and your client a lot of confidence in this plan. Now, who's in Kaizen? In the past 6 years, we've been trying to do try to take as much as we can from who we know has been buying Kaizen over the past 5 to 6 years. You can see a big chunk medical. We have a lot of doctors in the plan, clearly a lot of self-employed and financial services. Many of our lenders and employees of those lenders are in the plan. And then of course it's spread all over the place. So we're doing our best to get as much data out there to you guys in regards to who's buying. But as you can see, self-employed finances, medical, that's a big segment of the Kaizen customer. So peace of mind, isn't that what we do with when we're selling life insurance in general? We're providing that peace of mind for our clients. But we can do that with providing more benefits, more money into the plan, more confidence that there's been a tremendous amount of stress tests and work done to ensure that this is a good plan for your client. So here's how I kind of want to end the webinar with Monty. You might say, hey, I want to get started. How do I get access? I want some illustrations. You probably have a lot of questions. The first thing I would say is, Monty, give Monty a call. The number's up here, 805-413-7579, or email him. He will send you out the NIW selling agreement. It's basically an NDA explaining some of the commission splits and how that works, as well as just making sure that you understand the NDA part of our contracting. That will give you access to our website, kaizenplan.com. You will register there, and that will give you illustrations, marketing materials, webinars, training PowerPoints. There's a client PowerPoint up there. There are some videos that you can use for client videos. So once you get with Monty, that will get you access to all that material. And then keep in mind tranche dates. Tranche dates are going to be very important for you to kind of follow up on. Our next one that you would qualify for, because our first one is done January 27th, would be March 23rd. The way that this works, guys, the way that we can get the loan pricing and everything is that we borrow we borrow large amounts of money every 6 times a year, and we tranche all that money together to give us the pricing that we need for these smaller size premium finance cases. So every tranche, we have 100+ policies going in force at the same time. So we have 6 a year. We can go through more details on that if you have a case. We're working with Monty's team here on the case management side to work through the paperwork. You've got an incredible team that's going to know how to support you on your first case. So you're in good hands. Monty, do you have anything to close or?
Yeah, thank you, Travis. I really appreciate you coming out and speaking to everyone. I'm sure there's probably a lot of questions out there. We're not going to do a traditional Q&A here, but again, you have my information, and you can even reach out to your own marketing manager at Back 9 if you're working with us. If not, just reach out to me. We're excited. You know, we just became an approved brokerage house here for NIW, and like I said, I've known these guys for over a decade now, and it's really important because like I said at the beginning, the servicing part is such key to these products, because it's not a traditional sale where you just sell it. Maybe you'll call them every year or two to follow up. We have to follow up every year with these policies. So it's really important. You want to work with someone that has the experience to do these types of products. I hope you enjoyed the meeting. Again, just reach out to me. We're more than happy to give you additional information. We do have to get you contracted with NIW to give you access to their website, but that's just a little bit of paperwork, and we'll get you taken care of. So on that being said, I appreciate you giving us your time today, and I hope you really enjoyed the webinar. Talk to you later.